I'm going to make a bold claim that the worst of housing is over. Now, boots on the ground, you might sit here and argue with me, and I'm going to respect that. Because I know that days in the MLS is actually up year over year. And I know that mortgage purchase application, while up, is coming off of record lows. And don't even get me started on what's going on with the attached market and the warrantability duress with Fannie Mae and Freddie Mac. In addition, uncertainty is at record highs and consumer confidence just hit a 3-year low. But I want you to hear me out. I'm looking at the data for March, and I'm seeing that we're starting to rebound, albeit slowly. And will this take a while? Yes. But is the worst behind us? And that gives me hope. Because as an investor, as a true believer in the value of real estate and the opportunities that it opens up, both for home ownership and for investors, I'm looking at this going, I'm seeing nothing but opportunity. And I want to shout this from the mountaintops. Because by the time the rest of everybody else sees it, the opportunity passed. So here's what we're going to talk about. We're going to talk a little bit about the data specific to the Denver market. Now, you'll know your data specifically, so don't dismiss this video if you're not in Denver, because I think that a lot of it is going to be similar to what you'd see on the national level. I want to talk about the data for March per Denver. And then I want to talk about the economy and what predictions are for a recession, and then what that means for housing, and then ultimately where we might go later this year. Because all of that speaks to opportunity, and it speaks to the power that you get from having the knowledge of what's happening around us. Because if there's one thing that I can say with 100% clarity and certainty is that uncertainty is now our new normal. So we have to get used to living in it and making decisions despite it, decisions that carry our family's financial certainty and stability forward. I mean, that's the bottom line. That's all we can do is make the best decision with the information we have at the time. So let's talk a little bit about what's going on in the Denver Metro data, because we just got DMAR's data, DMAR's Market Trends Report for March, the Denver Metro Association of Realtors. And here's some of the data that's coming out of it. And some of the data is similar to what we're seeing nationwide. Inventory is growing. And in some markets, it feels like a lot, like maybe an abundance of inventory, right? Especially if you're talking about Texas and Florida and DC and Colorado. I mean, we all have more inventory than we had pre-pandemic. And more inventory means that the buyers have the upper hand and prices start to decline. And is that necessarily a good thing? I would tell you it is a good thing because it's going to moderate prices. But inventory is up. Bottom line, month over month, 14%, year over year, 67%. Active listings are also up, which means sellers are coming out. You would expect that in spring, and that's happening. Here, new listings are up 32% month over month and 29% year over year. All of this is bringing more opportunity to buyers, giving them more choices and more negotiating opportunities. Pendings, which is those buyers who went under contract in the month of March, is also up. Now, I know the pending started to come down at the end of March, and we'll really be able to see what April data looks like to make a determination if we've already hit our peak. But as of right now, pendings, or those buyers who went under contract, is up 41% month over month and 14% year over year. All of this, more active inventory, more new listings, and more pendings is bringing prices to a moderation. We're actually seeing that in March and year over year, month over month, that prices are pretty much flattened out. In fact, prices were down 0.2% month over month, and they were up 0.7% year over year. I'm just going to call that flat. This increases affordability. Ultimately, this will bring more buyers out. And it's doing that. Mortgage purchase applications were up for the last 6 weeks in a row, up 2% week over week and 7% year over year, even as rates are remaining higher. Rates have been bouncing around 6.75, but they've been coming. If I look at the beginning of the year to now, they've actually been coming down most of the year, albeit very slowly and certainly bouncing in a very linear path for a lot of that. This today makes our median price home in the Denver metro $599,000. Now, this is down 4% from our all-time high, from our peak in 2022. But as I mentioned, still flat, moderating month over month and year over year. Now, if I look at the last 5 years, we saw a massive uptick in appreciation, way too much for our own good. 44% was unreasonable and certainly not sustainable. And we saw a 44% increase, but since then, we've seen this flattened moderation that if I actually take the 5-year average of home price appreciation, I land at 6.92%. 6.92%. That's actually spot on, just a hair under, the historical average price appreciation for the Denver metro. So what we're doing is we're returning back to normals. Now, what will the next couple of years bring? If the next couple of years continue to bring more inventory and smaller demand, you're going to see that moderation continues. And our historical price appreciation, or our numbers, will start to go down even a little bit more, which isn't all bad. I get it. Sellers, we want continued increased appreciation. As an investor, I want continued appreciation. As a homeowner, I want continued appreciation. But at what cost? I mean, that's what I always talk about, everything at what cost. So at what cost is this inability or unaffordability for buyers to come in with this extreme price growth? And so now we've seen that moderate, which again is in line with the historic averages. And mortgage purchase applications are continuing to go up. And we will see those numbers go up even further as we see interest rates decline. So let's talk a little bit about that. Because when I say that the worst of housing is over, let me highlight a couple of other aspects of that on the economy side. The Fed is done hiking. We've known that. They're saying that. That is broadcasted. The Fed is done hiking. Now, we still have this massive uncertainty around tariffs and what that will do to the economy. We have a lot of predictions about what that will do to the economy, but time will tell. And many have asked if the Feds will actually increase the Fed rate if we see a spike in inflation. Now, the Fed right now is saying, per Jay Powell at the last Fed meeting, that inflation due to tariffs is temporary. I'm going to argue that. It's not up to me. Nobody called me. But if the going-in assumption by the Fed is that inflation increasing due to tariffs is temporary, they're not going to raise the Fed rate. Now, what they will do instead is hold the Fed rate higher for longer. But for right now, the Fed is no longer hiking the Fed rate. In fact, they've estimated 2 Fed cuts this year, and it's estimated that those are going to happen in June and September. And we'll continue to watch that. The big number is the mortgage spread. The mortgage spread has declined. Now remember, it hit just over 3%. This is the difference between the 10-year Treasury and the 30-year fixed mortgage rate. That mortgage spread increases as we have financial instability, and it decreases as we go into more normalizing times. And historically, that rate spread is 1.65 to 1.85%. So a 10-year Treasury might be 4%, and then the 30-year fixed rate might be 5.75, which is the historical spread difference of that mortgage spread. We hit the highest was just a hair over 3%, which meant that we had financial instability, which was causing our interest rates to go to 7.5% and even 8%. Well, right now that number has leveled down to 2.3%, much closer to the historical numbers as we are starting to see that financial duress reduce in the banking markets or in the mortgage markets, in the financial markets, all of that, right? All of that. So as the mortgage spread decreases, our mortgage rates can go down even if the 10-year Treasury yield doesn't. And it's a Treasury yield that's more directly impacted by the economy and by the Fed, and our mortgage rates are directly impacted by the 10-year Treasury plus the mortgage spread. So when I say that the mortgage spread is decreasing, that's kind of a big deal. What we're also seeing is that the last 6 weeks of mortgage purchase application data increasing, even with rates elevated, say that there are buyers coming out. There are buyers determining that they have to move on with life regardless of what's happening and getting used to higher for longer interest rates. So let's talk a little bit about where interest rates might go. JP Morgan just came out with their updated probability of a recession this morning, talking about the fact that they were expecting to see a 40% probability of a recession this year. Now, to put that in context, at the beginning of the year, they had a 30% probability that we would see a recession in 2025. Now, it's never a zero, right? Economic cycles are cyclical. You're always going to have some manner of a recession in the future. But is it expected this year? JP Morgan is now saying with 40% probability, yes, due to the uncertainty of the tariffs and their impact on the GDP, and also due to consumer confidence hitting a 3-year low. Consumer confidence impacts spending, and spending is 70% of the GDP. So if I'm having tariffs, which has a negative impact on the GDP, and consumer spending, which is going to have a negative impact on the GDP, both of those indicating a slower economy. In slower economies, not only do we have recessions, but we also have declining interest rates. We have a declining 10-year Treasury yield, and we have a declining mortgage interest rate that follows suit. This always happens when you have an economy that is steaming and is moving forward and pushing forward. You have higher interest rates to slow down some of that accelerated growth. But when you have slower economies, you start to have decreased interest rates in order to speed up some of that growth. And we tend to try to moderate that. With a slowing economy, with this probability of a recession increasing, by having a declining interest rate, we know what's happening right now with increasing demand. Start to imagine what would happen if we come down from 6.75. If we hit 6.5, 6.25, 6%. Could we see 6% by the third or the fourth quarter if we see an economic recession? There is certainly enough uncertainty to not claim it as fact, but to simply keep our eyes wide open and to say, if that were to happen, and if interest rates did decline based on this recession, and if more buyers came out, because yes, I know that while we see job loss during recessions, we also see plenty of Americans that still have jobs that have been waiting to purchase and sitting on the sidelines. Remember, we have 330 million people in the United States. With all of that, we're going to have demand on housing, and housing actually does well in recessions. Housing prices actually increase during recessions outside of the 2008 recession, which was caused by housing. All of that to say that opportunities exist today. Opportunities exist today to walk into each new month, this spring, this summer, and this fall with eyes wide open to say, what is the economy doing? Are we heading into an economic slowdown? And what are our housing numbers saying about the demand and the inventory and the activity? Those opportunities open up doors for homeownership. They increase the opportunities of affordability, and they make available to buyers today doors that have been closed, in my opinion, for way too long. So to say that the worst of housing is over is a stand I'm going to take. And I'd love to talk to you about what this means to you. If you're ready to take a look at jumping into the housing market, or if you just want to pass this on to a friend that you know has been sitting on the sidelines, please share. Please like and subscribe. And I'd love to not only chat with you, but to see you next time.